Hello and welcome into the KE Report. Shad and Corey here as your host, and we're talking today with our friend and colleague Erik Wetterling. Erik is known as the Hedgeless Horseman and runs the hedgelesshorseman.com. We'll put a link to that down below so you can follow along with his work and the stocks that are on his radar. Erik, we always like talking about the junior resource investing space with you, and we were talking, of course, about precious metals breaking out across the board as we see gold breaking to new highs and silver blasting above 40 and $41. The animal spirits are out. Twitter is ablaze with memes about the breakout. People are excited to see green on the screen. A lot of stocks breaking out across the board at all stages of company. And one of the ideas we were talking about off mic was just how do you posture yourself and keep your head together in a bull market, and how some of the trends change as far as how you average into positions, when you should sell, all those kind of things. So from a big picture standpoint, what are you looking at as far as the main things between your two ears during this phase of a bull market where it's a lot different playbook than during the bear market?
Right. I mean, first of all, I have no way of knowing where the gold and silver price is going to be tomorrow or next week or next month or whatever. And that's never been my strategy to bet on where the metal prices are. The best way I've found to not make the biggest mistakes by, let's say, selling low and buying high or selling too early, for example, is to simply be excited about the actual companies I own. Because, I mean, if you have no idea what you own, I mean, then you probably were selling the generational lows last year, for example. And I saw a lot of people did that and they went into, for example, crypto because it felt like it was never going to go up. And I've said this before, a trained monkey could beat this sector if you just had whatever mining index and you just started buying it when it was minus 50% and didn't stop buying it. So it's like all of a sudden now GDX is almost at the same level it was in 2011. 6 months ago, that felt almost impossible. That it felt almost impossible. So I'm even surprised by how well GDX has done. And also, it's like the gold price isn't that much higher than it was like 2 months ago, but sure, the sentiment is completely different because stocks have been starting to move up. And it's really, I mean, most people are momentum traders. That's always going to be like that. And if you just used to, I mean, if you bought the last high and only really seen a bear market until 2024, so you never really felt what early stages of a bull market, for example, feels. That's kind of hard to navigate because you have no like emotional reference and you haven't, navigated that part before. But so I would just mainly like to say that I think you should stick to your guns. So in my case, it's just, being a stock picker, company focused, because I have no idea when we're going to have corrections. We're probably going to have as many corrections in a bull market as we have in a bear market. And today everything feels absolutely great. Some stocks are going higher, or many stocks are going higher, etc., etc. But you need to be prepared that even if we're in a full-blown bull, the juniors can go down 20% in a week, even if the bull is intact and it's going to be 300% higher in 2 years. You don't know that at the time, but one thing I do again want to really press on is like stick to your guns, have a strategy, because anything you're buying today because sentiment is hot and you don't really know the story, you're just getting FOMO, which is super easy to do. I mean, fast forward and play with ideas like how are you going to act if the juniors are down 10%, silver and gold is down 3-4%, and sentiment is all of a sudden horrible, and people are saying that the gold and silver prices are going to go down even lower. It's like, what are you going to do with that position you just bought on FOMO? Because that's just a micro version of buying the entire sector high and selling the entire sector low because you didn't really know what you own. Nobody sells the bear lows in this sector because they're overvalued, the stocks. They think the price is going to go down even more. So I think there's a million ways to squander a bull. So it's like, don't kid yourself that a bull market is going to be so easy to ride and that we're going to have days like this every day in a bull market, and that's how it plays out. No, look at the 2001 to 2007 bull market. There were plenty of multi-month or even maybe a year of consolidation and plenty of corrections and all that. So it's like, keep that in mind if you want to make the big gains in a sense. You have to have a big gain strategy.
So, Eric, right now, look, this clearly is a bull market. I could not be more encouraged by the way that gold, silver, and the gold stocks and silver stocks are starting September. Higher volume, breakouts are continuing. Some of the breadth indicators can't be more bullish because of the fact that everything is running higher. So I think it's easier to ride a bull market when you have conviction in the sector because things are going up, and yes, you'll deal with some pullbacks, but broadly things are still moving up to the right. It's the question of when you see a stock lagging in your portfolio. Right now, I'm sure everyone's seeing their stocks moving higher, but there's probably a couple that are sitting in there that aren't doing anything. What do you do with those stocks in your portfolio?
Well, that's a very interesting thing where you have, again, those laggers, because let's say on 20 positions and you love them equally much, and then sentiment changes, and many of them, let's say, go higher, and they should for good reason. But you hold on to them, or most of the shares you have in them, because like, oh, you still think they're cheap. I mean, I know stuff that's up 200% since the 2024 bottom, and they look maybe even cheaper than they were 200% ago. But also then you have some laggards. And then it's like, because I'm constantly, in a sense, I guess, high grading my portfolio. I want to be in the cheapest stuff. That's why I never sell this sector entirely. I just try to be in the cheapest stuff in any point in time. And sometimes the average undervaluation might be 70%, and near the tops it might be, I don't know, 10% or something, and you have to go with more alpha. But some laggers, for example, they might have started out really cheap as the other ones that started around, but then they go up, the other ones, and some holdings are lagging. I mean, then also their relative undervaluation goes up as well. So it's like, I know a few that I own that are like that, and it's just super frustrating. I mean, I don't know if there is anything more frustrating than sitting in some stocks that is like they're not joining everyone else, because everybody else seems to be cheering for every single stock there is out there, and that's just going to piss people off even more, because that's like being in a bear market. It feels like being in a bear market, even though everyone else is in a bull market. So I would just again like to point that out, that there's plenty of cases out there where it's like the juniors had no business going down to whatever level they were down to, like we saw sector wide, but they just stick around. It feels like they're never going to go up, never going to go up. And then you start to believe that these are not actually cheap, they're never going to go up, etc. And then all of a sudden you sell out, and you come back in a few months and it's like, oh shit, it's up 100%, because you were maybe the last one to sell. So I'm looking at that stuff as well. I don't try to be a perfectionist, because it's so hard to know exactly what something is worth. I want no-brainers, in the sense that there's probably not a chance that I'm overpaying for this. And if I'm even close to fair value, I want the stock to have, let's say, a multi-month or multi-year pipeline of catalyst that could make today's price look even cheaper. But I would say it's like, don't give up on everything that hasn't moved yet, because we've seen that plenty of times, that for some reasons some stuff lags to the downside and lags to the upside. But if the case is intact, it's no change in the entire sector. 2024 gold was high, cases were intact. It was just a sentiment sector wide in that case that just were lagging bigly.
Well, Eric, I want to take the other side of the track and look at what point do you do value shuffling in your portfolio because things have run too much. And what I mean by that is we've been waiting for the sector to re-rate, and we could very much argue that's what's happening right now. We looked at development projects that had all these ounces in the ground, and it just didn't make sense how those ounces were being valued. Now they're starting to quote unquote re-rate higher, and those ounces are being worth more. We saw producers that had all this production, all these good things happening, all these sunk costs, and they were still trading at ridiculous levels compared to where they had been historically. And now a lot of those producers have re-rated higher. With explorers, it's a little trickier. Same with prospect generators, which are in the exploration business, because their re-ratings are based on news, and some of this news can see ridiculous moves to the upside or to the downside. It can be very turbulent, but sometimes we see stocks blasting up 20, 30, 40% in a day, and there's really not anything that's substantive. It's not like a developer or a producer that's re-rated. So if it's pre-assay risk or post-assay, is there a point where you value shuffle and start saying, hey, this thing's actually moved up so much, I want to high grade my portfolio by moving it over into these other ones that maybe haven't moved so much? So how do you deal with stocks that re-rate too quickly?
Oh, well, I'm very bad at selling. I drink my own Kool-Aid. I always think stuff can go higher. But I will still say that I think the second part of the Lassonde curve, advanced explorers and developers, etc., I think their risk reward is still, even though they have done better than most early stage and pre-discovery stories, I think they're still cheaper and provide better risk reward because like we talked about, the sunk costs, etc. I mean, there's projects out there with NPVs of whatever 1.5 $2 billion have like 2 3 4 $500 million spent on them, and they might be trading for a few hundred million. So how do you beat that? I mean, if you just reverse engineer what you would need to, if you're an early stage or pre-discovery story, just to redo those steps, it might take you 7 years and 300 million if you're lucky enough to have something similar. So I still think the second part, the advanced ones, the ones with proven success, they're still ridiculously cheap, a lot of them. But yes, we've seen also the earlier stage companies starting to move, and they are, farthest out in the risk curve. And if we're talking like the maximum move that's going to come in a junior, that's probably going to come from a early stage junior that in a few years from now has a lot of success, but the blue sky is still open, because we talked about this a bunch of times, that during the lows, the sentiment lows, you get nothing for potential. Even if you put out a news release and saying, our target expanded by 4 times or something, probably not going to move the stock, because everybody's totally risk off. It's like, well, that's potential, so there's risk in that, and high risk in that, and not even proven success gets priced in. So I mean, the way I'm looking at it, I'm still hodling, especially for example the family portfolios, which are more diversified typically, and they are based on not needing really to trade. I don't do a lot of transactions in those ones. So usually it's the top ones are advanced explorers, developers, even some producers with a pipeline for growth. So even if metals goes nowhere, I expect them to go up in value over the coming years. So, you're just happy if the gold price goes up. And when I feel like they are somewhat fairly priced, whatever, that it's not like a absolute no-brainer, a joke or a valuation, then you'll have to start going down and take some alpha risk at the end of the day. I mean, if you had a advanced play trading for 100 million, you have a pre-discovery play trying to find what the advanced play has and trading for 20 million, then the developer or the advanced play is probably insanely cheap compared to the pre-discovery play, because they would need, again, like let's say 5 6 years and 100 million to come up to their stage. But if that's trading for 600 million and pre-discovery early stage plays trading at 20 million, it's like all of a sudden it's like, okay, now the developers, advanced ones, they're getting some value for that success. So now you might get paid if you find early stage explorer that looks to be on the same track, because like honestly there's some early stage explorers out there that I think are quite overpriced. Not really like they're super expensive, it's just compared to the ones with proven success, it was all of a sudden makes no sense. But you can make money on all of them. But I still like to do, I mean, risk reward value shuffle. I mean, I never really like to be in a lot of advanced ones. I've mostly been a alpha guy, but this sector is 2024. It changed so much because it was so ridiculous, especially with the gold price being so high. You didn't even take the risk. I mean, it wasn't like 2015 when no project was economic. Some of these projects were super economic last year, and they were trading like they were super economic or barely economic. So I wasn't prepared to have a scenario like that. So that was new to me. And now again, like I said, I still have a higher weighting towards the advanced ones, because I don't think they've gone up enough to justify, let's say, reflect the amount of sunk cost, the project quality, the years of permitting or whatever. And I don't think they have gone up enough relative to most early stage explorers for the early stage explorers to have provide that good of a risk reward. The early stage explorers I own mostly now, I mean, they need to have really, really good targets. They need to be, a true shot at like tier one potential.
Yeah, fair enough. Well, why go down to the really early stage explorers to carry that much extra risk when right now there are a lot of projects, a lot of really whatever stage, as long as they have a discovery, especially if they have a resource. It's not like 2015 where the market was arguably trading at the cost of production. The market is trading well above the cost of production now. So, yes, a lot of these do make money. But then, Erik, the big question is, exit strategy. Obviously, going into the early stage explorers, the exit strategy, usually for a lot of people, actually, no matter what you're in, is some sort of takeout. Early stage explorers, that's going to take a whole lot longer than an advanced, usually development story. But even the advanced discoveries, those at least you can make the argument could be taken out earlier if the majors and the mid tiers really just start spending the money that they're making. What is your exit strategy? If you're in a lot of these companies that aren't producing right now, that maybe won't be producing in the next year or two, what's the exit strategy for you?
I mean, I find exit strategy again, it's like selling. I mean, that's the hardest part. I know I'm good at catching falling knives and being able to buy when I'm deep red. I'm typically very bad at selling, and that's why I try to make life as easy as possible by not trying to get that stuff, because that's the hardest part, right? I mean, if I was only looking for things I thought would be acquired in a year, I mean, I have a few ideas of what that might be. But it's like, okay, let's say some project is kind of fair valued and everybody's expecting a takeover and no takeover happens. It's like, how much do you make then? So I prefer actually to just be in stories where it's like, I don't know if they're going to be taken over, but I do think that they're going to be worth more in the next 1, 2, 3, 4 years, because then I don't really need to worry about an exit strategy in a sense. Because if I think that the value of these companies can just keep going up, I mean, exit or not, takeover or not, I expect them to be trading higher in that case, especially the ones that, let's say, they triple their value. They have a discovery already, and they prove up. They five bag their resources or something over the next 3 years. I mean, it doesn't take a rocket scientist that if you bought it kind of cheap, it's probably going to be trading at a higher price in the future. So again, that's why the hodl folios, for example, they're mostly open-ended. And people, ask me sometimes, what's your sell target for a stock? It's like, I have no idea, because I also don't know what news is going to come out. Or I might have an idea how or what price I might be willing to sell something I think is cheap today, but let's fast forward 6 months and it's up 50%. And maybe that was my previous idea. Okay, now it's not super cheap, but if they have grown the resource by 100%, all of a sudden they might be a bit cheaper even than they were today. So that's why to me, it's everything is a moving target. I just want to see that the companies have ways of, on a rolling basis, be worth more in the years to come. Because in that case, it doesn't really matter what the gold and silver price does. I mean, if it crashes 70%, yes, that's going to be a problem, obviously. But like takeover or not, I mean, if you have a producer that's growing, it's not going to, and it's not going to be taken over in 5 years. But if they go from 100,000 ounces of production to 300,000 ounces of productions, takeout or not, that's probably going to be worth more than it is today. So I don't try to think too much about that, and instead just try to stack the deck in my favor on a rolling basis. I always want to see that the fate mostly is in the company's hand and not in some third party that could take them over, or the metal prices or something like that. Because if you get the micro wrong and you get on average that kind of thing right, that they're actually going to increase in value, whatever, increase the resources or production, yada yada yada. It's like it's a fair bet that they're probably going to be trading at a higher price. But when you reach a company where it's like, okay, I don't see where the growth is going to come from. They don't have anything really that can move the needle in the next 3 years, and it's not like super cheap. I'm not okay with just 50% discount to what I think is fair value and no ways of increasing fair value over the next 3 years. Then you're stuck where you hope that some, gold is going to go up or some third party is going to buy them at a premium or something. But that's not just of interest to me. I mean, that's why I don't really give a crap about the Barricks and Newmonts, etc., because I don't see, except for just sentiment and gold price, I don't see what's really going to move them in a sense.
All right. Well, I think we'll wrap it up there. Some good thoughts for people to consider about where valuations can run the most, where the torque can be, where the upside can be. I mean, I do think it's important to eventually have an exit strategy, but I hear what you're saying that right now it's an unknown factor. And so there's a lot of value a company can build during the process of doing their drilling or putting out a resource, or doing economic studies that then actually make them a cheaper candidate where they could actually run for a longer period of time. So it's very nuanced and news dependent in the junior sector. But just really nice to see a lot of companies participating, a wide breadth of participation across really the whole sector for gold and silver right now. Hopefully, we keep that momentum going through the end of summer and into fall. And Erik, always great having you on the show to get your thoughts. For those of you listening in, if you want to get more of Erik's thoughts on the companies on his radar, definitely click on the link below in the show notes. Takes you right over to thehedgelesshorseman.com. And Erik, as always, looking forward to our next conversation.
Thanks, guys. And I would just like to end with is like, I think we're still very early. I'm not even thinking about exiting the sector, so to speak, because like, yeah, I mean, we're not seeing takeovers at premiums to NPV, spot NPVs or anything like that. I mean, most companies, advanced ones, aren't trading even close to NPV. So it's like, we'll have that discussion for another day, but right now I'm not even tempted.